first up, as you'll have seen in the papers today with the announcement, we've seen a significant growth in our gross revenues up to nearly 40 billion Kenyan shillings. So it's a 9.1% increase. But due to the increased cost of operations associated to the regulatory challenges, we've not seen that fully flow through to our profit after tax, which is reduced by almost 5%. The gross revenue increase is really driven by pricing on the back of the large excise increases that we had here in Kenya last year, improvements in our cut rag performance, which is a good value contributor to our business, but we've had to offset some significant challenges. So that is the reduction in our volumes on the back of aggressive tax increases, and also, as I said, the more aggressive regulatory environment and the increased cost of operations, which increased by about 26% in 2019. The excise increase was significantly more than the industry was talking to the government about and what we felt was reasonable. And the impact of that 20% increase, which was almost four times the rate of inflation, has had a significant increase on our volumes decline. What that means for the government, therefore, is that the amount of revenues that they collect, even though the actual excise has increased per pack, has gone down. So the government's revenues have reduced by 1.4%. So it shows you that the government strategy of aggressive tax collection is not working for them in terms of driving their revenue collections. And as I said, our operating margins have reduced by 23.8%, so down 6.2%. A lot of this driven by inflation, the increased costs that we have associated to the cut rag sales, and we've tried to offset that with a lot of our productivity savings. For those of you that have been here before, you remember we focus a lot on productivity. It's one of those big four pillars. We use the productivity savings to try and offset some of the increased costs in doing business. So to some of the notable successes that we're proud of from 2019, you'll be aware that we started to import a new nicotine category into Kenya the second half of last year. That product is called Lift. It's a modern oral nicotine pouch that is put into the side of the mouth. This is not a tobacco product. It's a nicotine product, and as you know, globally, the trend is for adult smokers are choosing to move into the nicotine category and use different kinds of products to access nicotine and stimulation. This was introduced in Kenya Q3 last year, and I can talk a little bit later if you like about how that's progressed. The important thing here is that this is the first time that this new product category has been introduced into Africa, so it's very exciting times for us, and it means that we are able to give our consumers much more choice, more innovation, and the potential for reduced risk versus smoking traditional cigarettes. Another area that we're always proud of are the people that work for our business. We spend a lot of time investing in the talent that we have working for us, and also attracting new talent to BAT, so that we've got a great team of people driving the sustainability of our results going forwards. In the last 12 months, for the third year in a row, we have won the Top Employer Award from the Institute of Employees based in the Netherlands, in Holland. And that's a great rubber stamp on the fact that the things that we are doing in the workplace are really delivering great results. Also, you might remember last year I spoke to you about the investment that we'd made in the workspace. So we have an office space which I would consider to be world class. We've invested a lot of the cash back into that space to deliver a great place to work for everybody that works in BAT in the Nairobi offices. So a little bit on the domestic market. None of this will be particularly new news to any of you, because you see a lot of the noise around these issues in the press on a regular basis. So the first big issue for us, I think, is the increasing business and consumer pressure And that the impact of that is that it's driving challenges for our consumers of affordability. So all of the big FMCG companies are struggling with affordability and the consumers being able to have the cash in their pocket to buy products. So this is not a BAT issue, this is a generic issue, but it's been particularly driven by the 20% excise hike that we had last year, which, as I said, was 4 times the rate of inflation. This was significantly higher than we expected. And as you know, we pass excise on to the consumer, so that's led to significant price increases, which the consumer finds difficult to deal with. So our big ask here with the government is to look at more inflationary-based specific rates of excise change, which would lead to increased revenue generation for government and collections, and also increase the stability of the industry going forwards. The other change in the regulatory space was the announcement of the introduction of the Salatium Contributory Levy. This is still work in progress, but it just shows you that the pressure on the business from outside and the regulatory pressure is significant. If I move to regulatory overreach, I think in this space we're particularly talking about the proliferation of county regulations, which has appeared in the press on several occasions. I think our job as a business is to make sure that the impact of devolution is not to make business activities more complex than they already are. So a lot of the time I will be talking to the big associations here and the government about encouraging ease of doing business and not driving the cost of doing business through a duplication of levies across counties, etc., and all of the complexities that come with that. We also saw the regulatory overreach stretching into the tobacco control, but I think you'll probably know that at state level there was some statement made that there is already a regulation in place for tobacco control, so they should not start duplicating laws and regulations.